All right, guys, welcome to tonight's webinar. We're going to give it one more minute. We see participants streaming in. We're going to give folks just a second to jump on, and then we're going to get on with our apartment educators educational event tonight, how apartment investors get paid. So we'll give it 30 more seconds here, and we will jump right in. Glad to have everybody with us tonight. We've got some good content for you, and look forward to diving in. I'll say it a few times, but I'll say it here at the very top. We're going to do Q&A at the end. So I think if you dig around, you'll be able to find a chat box or a Q&A section, and you can pop your questions in there as they come to you, as they occur to you, and we will address all that at the end of the webinar here. So let's dive right in. Welcome everyone to the Apartment Educators event this evening. How apartment investors get paid is our topic, exciting topic on everybody's mind. I'm one of your hosts, Devin Elder, and I have our other esteemed colleague here, Mr. Abel Pacheco. Welcome. How are you, Abel?
I'm doing good. Thank you for joining us. Thank you for jumping into our live virtual events here. So we wanted to talk about a good topic today, how investors get paid. But every month we have a recurring topic, and now during this quarantine time, we are actually doing these every 2 weeks, so bi-weekly, one during lunchtime and then one at the after work. So we wanted to share with you guys, a little bit of the vision for this. We started about a year ago, normally in San Antonio. We're meeting together, having a great time, all the stuff that if you are a social person, we miss right now, and being able to come together, shake some hands and say, hug each other, say what's. So unfortunately, we can't do any of that stuff now. But if you're in San Antonio after this pandemic time, we are going to be coming back, meeting together, and still continue with this virtual event, which is really awesome. So we're excited. It did kick us or push us into that opportunity. But, we're in San Antonio, Texas. That's where primarily we do the majority of our deals. And we started this meetup with the purpose of providing education to investors, education to other sponsors, education to other partners, because we want to build one of the biggest, local ecosystem here in San Antonio, Texas, the multifamily ecosystem here, because it really does help all of us in the environment, the group, the ecosystem, because the more people that we have here in San Antonio locally coming together, it just enables all of us to go do more deals, raise more capital, go win together. And San Antonio is a great market. If you're not aware of it, it's just a tremendous opportunity for multifamily real estate. So that's us. That was a little bit our vision. So to provide education and really enable us to network with each other. If you know a little bit of about syndication, we want to have a pre-existing relationship. So this enables us right now, during this time, if you're not connected to either the Apartment Educators, DJE, or 5 Talents, you can also connect on our Meetup. There's a group of people where you can chat and start to network that way until we actually get to shake hands again. So that's our multifamily meetup vision.
Outstanding. So we'll talk a little bit about the Apartment Educators platform. I'm one of the co-founders of this platform, and this kind of came out of years of investing in apartments and getting asked for mentorship and guidance on this stuff, and me just never having the time or energy or really feel like I could deliver a good experience for somebody. So I partnered up with a longtime friend of mine who has got, our family's been friends for years. Awesome guy, Ruben Dominguez, and we partnered up, and it's been a great partnership with complementary skill sets where we can go in and create this whole ecosystem. So what we do is we provide a complete ecosystem, tools, framework, education, and contacts for taking somebody in that's maybe interested and taking them from being outside the store with their hands against the glass looking in to being inside the store and actually being an investor. So we provide that complete ecosystem, the relationships, the framework, the financial models, the contacts, the connections, and it just shaves, potentially years or decades off the learning curve here to get people involved in apartment investing. We are accepting applications now on a very limited basis. If you want to learn more about that, you can go to apartmenteducators.com and check that out, or you can email my partner, Ruben, at apartmenteducators.com, and we'll see if there's a fit there.
Yeah. And if I could just add on this, Devin,
Sure.
I would say, man, if you were trying to figure out how to get into your first deal, your first multifamily syndication, or if you've already done, 4 or 5 of these things and you're trying to figure out how to do more, either way, this ecosystem and education platform, Apartment Educators, is a great one. I am a coach now for the platform, for the group. However, I started as a student also. So I've been, into the mentor group, into the coaching, and super excited. It just provides you a ton of value. So if you're trying to figure out what to do now, today, I think that's part of the advantages of Apartment Educators is, and learn everything you need to learn now. Get education, invest in yourself, and that is something that you're always going to be able to take with you, regardless of the time of the market. And man, when you're ready to get in, you already have the education behind you. So great platform. If anybody has any questions, let me know. There's probably some students online too. If we were in a meeting, we would ask everyone to kind of raise their hands. But if you need some referrals or want to talk to somebody that's in the program as a student, let us know. Happy to share referrals with you as well.
Good stuff. So a little bit about us. My name's Devin Elder. I grew up in San Antonio. I have, at this point in my career, been investing in real estate since 2012. I've done hundreds of successful investment transactions and am invested in about $130 million of apartments right now today. A little bit about, why I'm here. I got frustrated in the corporate world, was kind of climbing that ladder and didn't have a lot of excitement for my future there, and ended up becoming an entrepreneur through real estate to be able to pursue the kind of life that I wanted to have. And so why do I come here and spend time on a weeknight when usually my family's eating dinner right now, or I'm playing in the backyard with my kids? And it's really just kind of comes down to simple math equation. When we have our existing deals, I've got partners on those deals, I've got investors in those deals, and we go out and we buy a $20 million building, right? That's possible because of partners and investors. So that all happens kind of organically, naturally, and it happens at networking events. So it's highly likely that out of the people watching this right now live, a small percentage of those are going to be action takers, and a percentage of those are going to be extreme action takers that actually decide to go do this. And the chances of us partnering on a deal and both of us making a lot of money is very high. We're hoping to close a deal. We've been hoping to close it for a while, but I've got a partner actually out of state that I'm hoping to write a $250,000 check to once this thing clears, right? And so that's the kind of, power that we have going after these bigger deals. And he's a kind of a silent partner. He's not even the guy out there doing the day-to-day work, right? And so that's the kind of thing that happens through these partnerships. We want to meet quality people. We want to surround ourselves with like-minded people, get educated, and go do deals. And so that's why, that's part of why I'm here. And I also like kind of seeing the light bulb go off for people when we're coaching people or walking through stuff. I remember actually talking to Abel. This is like a couple of years ago. He said something like, "I'm so fired up," and I said, "Man, you're being fired up fires me up, because the stuff doesn't fire me up anymore. Like buying the deals is kind of like, all right, yeah, I've been doing this for a while. It's kind of like whatever. But seeing you get excited about it, that makes me excited, and I like being part of that kind of fresh energy that people bring to these projects."
Absolutely. And you did fire me up, baby. So my name is Abel Pacheco. I'm the president of 5T CRE, 5 Towns Commercial Real Estate. And what Devin has said, man, is spot on. Really, when I first started figuring out I wanted to be in multifamily, I had been in real estate since 2008 and made a decision in 2018, 10 years later, that I wanted to really move forward quickly. And the education was there, the mentorship, coaching. He made it very easy for me, to. I was like, man. So now we're in 8.
So I've got a little bit of a pause on Abel's audio. I'm not sure if you guys are hearing that as well. Let's see if he can jump back in here. If not, we may cruise on and cut Abel's story short. Let's see how the audio comes back. And I see some Q&A coming in, so thank you guys. We'll get to those kind of at the end of the stream here and get that going. So I think we can advance the slide now and kind of take it on to the next step here. So why multifamily? For those of you maybe that are kind of newer to this space, there's some high level components here that we want, right? The first is the return on our capital, right? If we invest capital, we want cash flow, monthly or quarterly money coming back to us from that investment. And that's a very nice perk here to multifamily investments and a primary reason for a lot of folks. Then there's equity. We want to buy at a certain price, create value, and make it worth more over time, right? So part of that's just going to be natural appreciation. Part of that is going to be something called forced appreciation. This can be a passive investment. In fact, for most people in a deal, majority are passive investors. You know, they've made their money in business, or they're still working, or they're a busy professional, dentist, doctor, attorney, etc. And they want to, they have money. They don't like what oil or the stock market's doing, and they want to put it something that's backed by a physical asset like real estate and just passively let it generate income. So that's a big one. Then we have tax benefits. So we just finished kind of a round this of sending out what's called a K-1 to our partners. And a lot of those had big paper losses on there. So they can actually make money and realize a paper loss. And so huge tax advantages there. And then number 4 is that it's a safe asset. It's actually backed by something. And while it's not completely immune to market conditions, it is insulated in a lot of ways in the fact that it's dirt, it's bricks and sticks, it's a building, and it's an income stream. So there's a lot of benefits there on why we like multifamily. And this is true 30 years ago. It was true a year ago. It's true today, and it'll be true in the future. All these components here. That's the 4 kind of primary reasons we like multifamily. So we can kind of jump on here to the next one and get into what types of apartment investors there are out there in the world. Because when we talk about an apartment complex, you know, this might be 10 units, but it also might be 300 units. Who's buying a 200 unit apartment building? So there's a couple of different buyers out there. REITs, which are big real estate investment trusts that go out and buy these things, and then they get investors that are more akin to stock investors. Institutions, so you might have insurance companies, you might have pension funds, those kinds of things. And then you've got passive investors and sponsors, guys like us, that we put a team together. You've got one person or a team of people that say, hey, we're going to go lead this thing. And then we're going to get a bunch of passive investors that really don't have to do anything but write the check, go into the deal, buy it, operate it, profit from it, and move on. And so when you see if you drive around and you see an apartment building on the corner, the likelihood that a group of regular folks owns it is probably pretty good. And a lot of them are owned by just regular groups where you've got a sponsor running the deal and they've got some passive investors, and on they go. So next up, for passive investors, Abel, you want to jump in and kind of tackle some of the benefits here for those folks that are
hopefully everyone
the majority of investors? There it is, back in black. Yep.
I guess it wouldn't be an internet live virtual stream without some interference on my side somewhere. So it's good to see you guys back. But yeah, on the passive investor side, man, this was one of the reasons that originally drew me to investing on the multifamily side. So I've been a long time IT sales professional. If anybody's in San Antonio, you may know a little bit about Rackspace. Company went from, couple $100 million to X billion dollars, right? Ton of growth. Well, I knew that in the professional world, you can earn as much money as possible, but if you don't invest or figure out a way for your money to make more money, then you're going to end up working until, you finally get that time, age 60 something plus, and trying to retire. Well, I knew I wanted to do, more, and that brought me to passive investing, and you can still hold down a a full-time or professional job. You can still work your normal 40 hours plus a week. If you make a good, W-2, a solid income, you're also getting taxed pretty heavily. So there's some major advantages of being a passive investor. And that's, my first 400 doors that I invested in, 2 apartment complexes. I wanted to create the ability to create some cash flow, put some equity into a real estate, a real property that appreciates over time. I wanted the tax benefits, and I wanted to be able to have nice, solid, stable returns without the volatility of the stock market that I think we are all seeing today. And that's what really a passive investor. So, what we're talking about, how investors get paid. Well, one of the main ways a passive investor would earn is all of these 4 things. You create a recurring, whether it's quarterly or monthly dividend or distribution or income payment, however you want to, you invest your money in, and you get a distribution on a, whatever interval that time that is. When people say mailbox money, AKA passive investing money, that's what you're trying to create. And that's one of the major sources of investors when they get cash flow. But even in times like this, when, it's kind of crazy, you're still creating additional equity in the property, because every time you improve the property, force appreciation up, you're improving an individual unit, and it was renting at $900 and now it's renting at $1,000. Because of your forced appreciation, you're now creating extra equity in your property, in your project, down to your actual investment. So any investor that buys a portion of this limited liability company or passive investor side, you own a fraction of that investment, and everybody has an equal fractional share. As it goes up in value, we create more equity as well. And for cash investors, you get so especially if somebody can qualify as a real estate professional. If you're a full-time W-2 employee and you cannot, perhaps your wife can, somebody else can within your family. If you're a real estate professional family there, you guys have some massive tax returns. And even just in general, there are cost segregation studies that get run. We're essentially taking, 27 and a half years of depreciation on a building, and you squeeze this down into just the first few years of what's called accelerated depreciation, and all the way up until 2023, you have bonus depreciation in your first year. So those tax benefits are really what a lot of investors will use, whether they're high W-2 earners or whether they have a large capital event within another business or another piece of real estate. You're trying to figure out how to avoid past taxes that have built up, and you're trying to figure out how to reduce some of your W-2, your taxes. And really, I mean, that's for W-2 employees, this is the biggest expense you'll pay. It's not your mortgage, it's not your car. Over your life, the biggest expense you're gonna have are taxes. So if you can figure out how to, play within the rules, which we do, and you figure out how to, work with the tax man on his system and say, oh, this is the rule, yeah, I can take that. That's the benefit of being a passive investor. And then, typical returns, we're all looking for, just under 2x in 5 years, meaning if I put 50K in an investment, I'm trying to figure out how quickly I can double that money. Maybe it's 5 years, maybe it's a little, after that return can be broken up into preferred returns. Every operator, every team, every syndication team, kind of does this differently. So every deal's different, but if you're bringing in a 7% preferred return, it's building up some cash flow, building up some stream of income. If you have multiple sources of income, that's the best strategy. Don't have one stream of income. Maybe your job, have a second, a third, a fourth, a fifth. They say most millionaires have over 7 streams of income. This is one of those passive investor streams that we can create on each opportunity. We create some cash flow, build equity, get some tax benefit, and then have some great returns.
Awesome. Yeah. So lots of benefits for passive investors there. Absolutely. So we can kind of move on to the next component here. And we're going to talk about for sponsors. So, the previous slide, we talked about how passive investors get paid. You invest in a project, you get paid in those ways. And then as a sponsor, this is the term typically used for the person running the deal, the person who's ultimately responsible. You can think of it as the CEO of this operation here, right? And so they're responsible for executing on that business plan and putting the team in place to do so. So there's lots of ways sponsors get paid, and it can be very lucrative, right? So number one is through cash flow. And this is if the property makes $100,000 a month in income, just throwing out round numbers here. And you've got, let's say 50% of that is expenses. And then you've got some, well, I would say operating expenses, right? So your payroll, repair and maintenance, on and on. Right. So you've got half of that. You got $50,000, and you got to pay the mortgage. Right. And then what's left over is cash flow. So after you pay all the bills, operating expenses, and the mortgage, now you've got cash flow. And ideally, you want to get these things in a position either immediately where it's producing cash flow if it's a little nicer, cleaner property, or maybe it's a big turnaround property and it's not going to cash flow for a year, but you can buy it cheap, make the improvements, and then have excess cash over and above your expenses. And then what you do is you send that to your passive investors, and you can send some to the management team as well. So a lot of times these things are split 70-30. So you might see if there's $100 of cash flow, the investors might get $70. And then the management team gets $30, right? As a simplified example. Same thing on the equity. So the equity is really kind of the biggest chunk of cash in these deals, right? And it typically comes at the very end of the deal. So you're going to buy it, make some improvements, operate it, and then exit. And at the end, let's say you make some improvements and you have $2 million, let's say a $1 million gain at the exit after you've paid off the mortgage and everything. Well, you're going to send $700,000 to your passive investors, and the management team or the sponsor is going to keep $300,000 in that 70-30 split example. Now, you might have created $5 million of value at the end on a bigger project. 70% of that goes to investors. 30% of that goes to the sponsor. So you can put together a deal where the sponsor's got a multi-million-dollar exit at the end, right? Which is pretty compelling, especially kind of given other business models you might be considering. And this is typically over a 3 to 5 year hold period is how you typically set these things up. The acquisition fee is another big one. So as a sponsor, there's a lot of work involved. You in fact are doing all the work for the project. Your passive investors are doing no work. You're the sponsor, you're running the show. And you may elect to take an acquisition fee on the front end. This could be 1 to 3% of the purchase price is typical. So let's say you get a 2% acquisition fee on, I'll just bust out my trusty calculator here, on a $10 million project that you buy, there's a $200,000 fee on the front end. Now, you've got overhead too. You might have partners to pay, you might have analysts to pay, you might have payroll. It's not just free and clear, but it is some money on the front end so that you can keep operations running. And that is, the reason that acquisition fee is there is so that operator can be in business, right? Because you might go 6 months without a deal. So an acquisition fee can help keep the lights on for that sponsor. So those are kind of the high level at the front end. We've also got an asset management fee and a property management fee, the next two, while you own the property. And some typical ranges on that, an asset management fee might be 2% of collected revenue. Property management fee might be 3% of collected revenue. So you get about 5% of collected revenue. Not a ton of money. If that property's bringing in $100,000 of revenue a month, you might send $3,000 to the management company, and you might send $1,000 or $2,000 to the sponsor, right? So as a sponsor, if you're making $1,500 a month, that's not going to change the world, but it'll help keep the lights on. You may own the property management company and hire the staff and everything yourself, in which case you're getting that 3% as well. Or you may elect to have a third-party property management company do that. And there's pros and cons to both. But those fees are in there. And then the disposition fee at the end, you may or may not elect as a sponsor to take that fee We've got that in one of our deals. It's 1% exit, and then we haven't done it in any other deals. I don't see it done a lot in my kind of circle of friends that are sponsors, but certainly it exists out there in the world where folks are saying, hey, if we exit this thing, it is going to be a lot of work, and there's a fee built in at the end. So that's a typical scenario. I want to go back to point two here, the 70-30 split. That's a common split. There may be other arrangements where, if it performs past a certain threshold, then the sponsor is going to get more. And this is called the waterfall structure, where, hey, we're going to split like this up to this amount. And then once we hit this trigger, then the splits change, and there may be multiple hurdles there. And that's fine. I think, that incentivizes the sponsor to overperform, and that's a good thing. The way we structured it on all our deals is just to do kind of one split, very simple. It's easy to explain to folks in 5 minutes on the back of the napkin. I like that. In the future, maybe we look at different models, but I like the simplicity of that model. So that's kind of the high level on how a sponsor gets paid. Typical return, what we do when we underwrite a deal, we look at, hey, what is the return we can get to investors? Can we get them a 7% return while we hold this thing, and then turn it into a 15 or 18% return in total after we exit? Because that gets me excited, and that's a great return for our investors. So if we could do that, okay, we could do that. Well, then what's the return for the sponsor look like? And it may be a multi-million-dollar return over the life of the project, right? So now, granted, we've got expenses and things while we're holding it, but it is pretty compelling when you start looking at the kind of total compensation for a sponsor on a project. Abel, you want to fill in any color on that? Maybe I missed out.
Man, I think that's a great breakdown. One question that I do get a lot, and I thought I'd maybe help simplify this too. A lot of investors, when they're trying to figure out, well, I'm going to invest 100 grand or 50 grand, how do you know my money's going to double? And it's very different than or it double in 5 years or whatever the time. Every deal is a little bit different, but the reason we can predict with some kind of predictability and some kind of certainty in the deals is really with our underwriting. We make it extremely conservative up front. So, when you're looking at a deal and say, well, we're going to invest a few $1 million, we're going to buy a $7 million property, and when we sell it, it's going to be 10 or 11 or 12. And that means our equity doubles. And so everybody doubles their money. It's a big mathematics equation. It's a very, conservative Excel footprint that you're looking at, and you're trying to say with some degree of certainty, there is X amount of population that needs housing in this particular market or submarket. I can see the demand there. The supply is going up. The demand is the demand is going up, and the supply is not. There's a fixed amount of land and housing in this submarket, and so it tends to drive price up. The value of these apartment complexes are basically determined on your net operating income. So when your net operating income can be determined in advance and said, if I do these upgrades to an apartment building, let's take it down to 1 unit. When you walk into an apartment, I'm not sure the last time you did, I was in college, but I walked in and I saw old carpet, old fixtures, an old sink, and an old room. And I was in this apartment. I was like, I guess this is a $600 apartment back then. I was college. And I also walked into my friends' apartments who were spending $1,100 or $1,200 or $1,300 in that time. And theirs looked nicer than my parents' house. Granite, countertops, super nice fixtures, beautiful flooring. And people say, you know what? I will pay the extra few $100 to live in a nicer apartment. And so when you look at the comps in the neighborhood or the market and say there are other buildings that have this kind of interiors, nice floors, nice fixtures, I would see myself spending $800 or $900, and it's going to make $200 more per unit. And then I have some experts like property managers who manage this stuff every day, day in and day out. They know the market, they know the supply, they know the demand. They're also looking at it with an independent eye, independent of yours, and saying, with predictability, a degree of certainty, I think we can rent this unit for $900. Well, when you bought it and that unit was running at 600 and you push that rent up to 8 or 9, now you're looking at the multiplication of $300 or 250, $300 cash flow. Every unit, multiply that by 115, 120, 280 units, the net NOI just skyrockets. And that's where we're all making money. And that's how we're pushing the value up, so that we can predict with a degree of certainty, this is how I'm going to get paid and this is how I win. So there's a lot of those, Excel, there's a lot of work there, but when it comes down to it, we've got a type of product that's pretty simple. It's not rocket science. It's not IT hosting. It's not, some crazy molecular whatever bet that we're building. It's not the healthcare issue that we're trying to solve. It's like, oh, people need housing, and this is how much housing goes for in the area. And it's very simplified when you look at it. As long as you're conservative, your basis is low, just like any investment. You got the right basis, and with the plan that you can push equity up, man, we're all going to win. Sponsor, limited partners, property managers win, the asset managers win, construction managers win, our community wins, and we're all winning together and making a lot of money. So that's kind of the goal.
Awesome. Yep. That's a great overview. So that's kind of a high level on how the sponsors are compensated, some of the typical structures we see. Not every deal is the same. Every sponsor might have their own approach. And so it's important to get to know a sponsor and how they operate first before you invest. And that's just part of your due diligence as an investor, or if you're going to partner with somebody, et cetera. So I think we could kind of move on. I know we've got some questions coming in. I'll just reiterate, if you have a question, there's a Q&A box at the bottom of the screen there. Go ahead and throw your questions in as they come up, and we'll get to them at the end. How to get started investing in apartments. I mean, I've seen this 3-step process play out a lot, enough to know that, hey, this is the way to do it. This is how I did it. This is how countless other people have done it. But step one, you can invest passively in somebody's deal. If you're brand new at apartment investing, there's acronyms. It's like a new job, right? Everything's kind of new, and you have to get your lay of the land and understand it, right? And so that's kind of the first step, is to be kind of a passenger on the bus. And then the second step would be to try to get on the management team by adding some sort of additional value other than just investing money, right? And that might be some expertise that you have. It might be assisting with some of the duties that primary sponsor is doing. And that way you can get a little bit more equity in the deal and a little bit more responsibility, but it's still not all on your shoulders. And then step 3 is, you jump out of the nest and you sponsor your own project. And I've seen these 3 steps happen in a year, right? On an aggressive level. Or some folks say, hey, I invest passively. I have a high income. I like my job. I'm done. I just want to invest passively. And I'm going to invest with 10 different sponsors all over the country and really diversify, my investment pool, right? And so that's a good strategy. You don't have to do all 3 steps. Other people stop at step 2 and say, hey, I'm really good at a certain component of this. I'm going to partner with a proven operator. I'm going to do something that I can add value on and partner that way. So you don't have to do all 3 steps, but if you do want to do all 3 steps and go run your own deal, this is a very, I don't want to say easy process, definitely not easy, but it's simple, right? To Abel's point, it's not rocket science. I mean, we're just providing housing for people, and it's not, it's not apartments downtown that are renting for $5,000 a month in most cases, right? So it's pretty cut and dry kind of product that we provide. What we want to provide is housing for somebody that's making the median income or a little bit better. Provide something they can afford, because that pool will always be huge, right? Even if we got crazy stuff going on with the economy and all investments are impacted, we still have that demand for somebody with a median income to need some housing. So those are the 3 steps to get started in investing in apartments. And I think we can kind of move on. I know we've got some Q&A coming in here. We're doing these meetups regularly, and pretty soon we'll come out and shake hands with guys, but put it on the calendar now. It's May 7th at noon Central. And our topic is going to be how to prepare for the investing opportunity ahead. So right now, as we record this, we're kind of hopefully coming out of this global shutdown for COVID and all that. And it's just been totally unprecedented and wild. But we'll come out of this thing. And when we do come out of it, it's going to shake the tree loose of some opportunities, right? And so there'll be some opportunities. So we're going to cover and prepare you guys for how to be prepared for the investing opportunity ahead in 2020 and the subsequent years. So you can put that on your calendar. If you want to register for that event, you can go to apartmenteducators.com, like our Facebook page, Apartment Educators Facebook page, and then, like I said, hit the website and you'll see where to register for the next event there. We've got some Q&A that I want to kind of jump into now. One is from Bruce. What are 3 challenges you're both experiencing in the market? So, I mean, there's definitely challenges. You know, I terminated a deal we were under contract in like a month ago. It was really painful to do, cost me a lot of money, but it was better to get out because of all the uncertainty with lenders. So number one, I'd say lender uncertainty at the time. Now, lenders are still getting deals closed, but this was like a really distressed deal, and there was no way it was getting closed. So capital markets seizing up, right? We all know in economic cycles that it's musical chairs. And every 8-10 years, the music stops and somebody's left without a chair, right? All that capital seizes up, and that's certainly what's happened. It's started to loosen up a little bit now, and clean deals, I would say stabilized deals that are already full and performing, they're still getting closed, but a lot of deals have just blown up. So that's painful for brokers, for owners, sellers, buyers. That's painful for everybody, just like it's painful for bartenders and waiters, and you name it, industry is being impacted right now, right? So challenges that we're experiencing, definitely capital markets seizing up. I also think, you know, equity, nobody's really going to want to invest for that, you know, right this second. I think the fog starts to lift here in pretty short order, but debt and equity is a challenge right now. And then, of course, the big one that we're looking at as a challenge is collections on site, right? The whole thing is based on people having a job to pay rent or some sort of form of income, hopefully legal income that they can pay rent with, right? And so that's been impacted. Now, it hasn't been impacted in April as hugely as maybe people thought. I think May is going to be a challenge, right? We don't know where collections are going to be. You know, and it doesn't help that the governor comes out and says, you know, kind of gives everybody a pass on paying rent. So you've got some headwinds there, right? A property has to be able to collect rent in order to pay its bills. And so that's a headwind right now. Fortunately, I don't think this is a long-term or year-plus headwind. I think this is a relatively short-term headwind, but it's definitely going to be a challenge, right? So how are we tackling those challenges from Bruce? Just like a lot of businesses and a lot of people right now, just focusing on an hour-by-hour, day-to-day basis. Way more communication with our investors, with our property teams, with our lenders, you know, daily or weekly communication, being very open with residents and trying to work with them, right? On kind of a case-by-case basis to see how we can work with them to be able to collect that rent, whether that's waiving credit card fees on paying rent or renewing leases without a rent premium that otherwise might be there. I mean, there's kind of a whole myriad list of things that we're doing at the property level, providing different resources that offer rent assistance. I mean, it's really given us, we've just got a laundry list of tools that we use on site to help people. So those are some of the challenges, certainly not all of them, but some of the challenges that we're facing. So another question from Derek.
Before you move on, just the other one on the challenge, I'll give you guys one that waiting for the city to provide some permits so we can break ground on a new project. That's literally what's happening right now. And I saw an article that said 70% of new construction projects are delayed because of permits right now from the city. So while it's kind of like what Devin's point, over communication with the city in this example, it is trying to figure out how they're going to move forward, how they're trying to adjust from working in office to remotely, and how to get people, you know, to approve certain things. And, you know, that's exactly the challenge that I would say for new construction is the same multifamily as it is that one. So we're working through it, baby.
Yeah, buddy. That's it, man. Just like everybody doing. I mean, look, you know, you got parents struggling with homeschooling. Everybody's got some challenges right now. The thing I keep thinking about is, one of my ancestors is looking down right now from heaven that lived through, World War I, going, come on, man. Somebody that's
I love
stormed
it.
the beaches of Normandy or ate shoe leather during the Depression is going, come on. So we just keep after it, right? Like anything, any challenge life throws at us, you just keep getting up and getting after it. Question from Derek. How do you deal with raising property tax values? Yeah, this has been a real concern, especially in Texas in the last few years. Property tax valuation is really getting high. We hire attorneys to protest our taxes, and if they get our taxes down, we pay them. I think I'd have to look it up, so don't quote me on this, but I think we pay 20% or 25% of the saved amount. If they save us $10,000 in taxes, they're going to send us an invoice for $2,500. I think that's the range. And if they save us nothing, then we don't pay them anything. So it's a pay for performance deal, which is great. I actually got an email today from one of our attorneys. He said, I do not recommend we protest the value as the tax assessed value went down $800,000. I was like, man, are we living in a bizarre world or what? I mean, you've got, cats and dogs getting along together. I was like, hey, okay, property tax went down. That's great. Now, that was not Bexar County. So waiting to see what Bexar County does. So what we do is we just hire a tax consultant every year to protest that on our behalf, right? And then we pay them a percentage of them of what they save us. And I recommend hiring a professional to do that. And then if it gets bad, you can file a lawsuit against the county, which we've done in a few cases. And that's just what you do as a commercial property owner. So we've got another question from Bruce. What markets are you guys invested in? I'm personally invested mostly, almost exclusively in San Antonio, some in Austin, and I've got a project in New Mexico that I'm a passive investor in. Abel, I don't know if you want to dive in on markets.
Yeah, from San Antonio market, like you said, primarily one, and Texas for me. I'm trying to break into Corpus Christi, and the other opportunity that we're talking about is in New Mexico, Rio Rancho. And we typically look for markets that are close to us in our general vicinity. It's great to not have to be able to travel to them. If you think about right now, I think sponsors or teams that would normally travel and fly across country to go manage their properties is a little more difficult for them. So there's that advantage of having the local team right there in your backyards, which is great for the fact that we're in San Antonio. Corpus for me, 2-hour drive south. And then the reason we're in New Mexico right now in Rio Rancho, there's the core, the majority of our team on this deal, it lives there, and that's their backyard. We're helping everyone put together. So those are markets right now.
Awesome. I'm just going to pick another question here from Dell. What is the vacancy rate multifamily in San Antonio you're seeing? I think vacancy right now, at least on our portfolio, we're still in like 92 to 98% occupancy, right? It's really more on kind of collections and delinquency. And so that kind of varies per property. Some properties we're right in line with where we are every month in terms of collections, so kind of no change. Some properties we've seen single digits or high single digits off from where it was last month, right? So if we were collecting, $90,000 last month, we might have collected $80,000 so far this month. So that's a miss, right? We don't love that, but at the same time, we're also in, a globally unprecedented situation. So May is a concern for all apartment owners, right? That was, I think a lot of renters had cash for rent payments. So now as stimulus checks start hitting, et cetera, is that going to bolster things for May? We don't know yet. So we'll wait and see. We hope that we don't see too much of a dip. So that's a good question there. Another question, can I get a recording of this webinar? Yes, we'll send it out to you. We have a question on cap rates and what is the average cap rate you're seeing in San Antonio area? I think before all this COVID stuff, I think we were kind of in the 6s, in the 5s for nicer stuff, newer stuff, kind of a broad overview there, but that's on multifamily 70s and 80s vintage stuff, seeing cap rates in the 5s and 6s. We'll see what happens to cap rates over the next 6 months or a year. It'll be real interesting to kind of watch that and see, how much that's impacted by all this COVID stuff. We've got a question from, let's see, can you elaborate on the conservative valuation? What is the margin of safety? So we do a lot of things in our underwriting to build in a margin of safety. One is we take that exit cap rate and inflate it a little bit. So if cap rates are a 6 right now, we kind of want to see our cap rate when we sell it like a 6.5, maybe a little bit higher, maybe even a 7, right? You want to push it up a little bit higher. That actually makes the deal look worse, and you want to have some safety there. You also want to do, you want to build in cash reserves. Any business needs cash, right? And when people get in trouble in a business, a lot of times it's cash. So you want to have cash reserves over and above what you think it's going to take to renovate and operate, and an operating reserve, and then a reserve on top of that. You want to have a lot of cash. And so those are some of the things there. And then you want to bake in some safe assumptions on how far you're going to be able to push rents, what rent growth looks like. You don't want to get too crazy with any of the assumptions, because it's real easy to make an Excel model do anything you want it to if you manipulate the numbers enough. So you really just have to build the numbers and bounce it off a property management company that, hey, can you guys operate to this budget? And they need to have buy-in on that. And I think, Abel, you want to talk about the conservative underwriting process a little bit, or add to that.
Yeah, I would say, I think you hit the high points of it, right? But if you're planning on pushing rents, and you have that in your pro forma, like 2 months ago, you would have your pro forma to say year 1, year 2, year 3, and it's going to keep rising and building on each other. A conservative way to do that right now is to not raise rents in your pro forma. That doesn't mean you can't try to raise rents after the pandemic and COVID, all this stuff passes, but maybe not plan for that. Keep it steady. Maybe even use last year's T12 with high operating expenses and low rents, and you use that for your future year 1 or maybe even year 2. And you're trying to figure out how to beat this deal up hard enough, stress test it. Maybe if it's at 90% occupancy today, 95, you may plan to push the occupancy up, but instead in your underwriting, you may want to bring it back. How far could the occupancy drop and still maintain the debt service coverage ratio that the banks want? Is that 80%? Is that 75? Could you handle 60% occupancy? Man, if you do, that's a stellar investment. But that's what you're looking for. You're looking for that sensitivity analysis or the stress test on it to see what could this property take, how bad could it get, and know that I'm not going to lose any money. I'm going to stay in the investment. I'm going to ride a bad cycle out. And if you're doing that, it's going to go up and to the right. And then you're planning for the worst case, but in reality, people need a place to live, and you do push rents. And over time, all of this pandemic and the market cycle comes back up, and typically, 08, couple years, and the 80s, a few years, and 2 or 3 years, you have the market starting to hit back up again, and you're in this ride for 5-year ride. You don't tell investors this is a 2 or 3 year investment, and then we're going to have your money back. You tell them plan for 5 years and pretend you don't have that money. And if we get out in 3, then great. But if worst case scenario, you're planning for that, a little more conservative on that side. So those are some of the ways there.
Yeah, love it. And just to reiterate, cash reserves if you're an operator, and then some more. Take what you think you need and double it. Just because within reason, right? You can't have too much equity or it breaks the deal, but you want to have cash reserves, for sure. So some of the question here, what do you think about investing out of state? I live in South Florida where the prices are too high. So personally, for me as an operator, I want to invest, I want to run things that I can see quickly, like 20 minutes from my office type stuff. That's just my philosophy. As a passive investor, I'll invest with somebody in Georgia. If I get to know the operator, I'll invest, in in a lot of places. You kind of want to look for business-friendly environments, because there's some states that are not business-friendly. You want to invest in business-friendly states. As a passive investor, I like investing out of state. As an operator, my personal philosophy, and other operators do it differently, I want to be able to get to that property, in a couple of minutes from if I can. Got a question here. On average, from Chad, on average, how many apartments do you run numbers on before you move forward with an offer? That's a great question. In 2019, my firm as a primary sponsor, bought 2 properties totaling about 400 units total. We probably looked at 50 or 60 deals that year. I could pull the numbers up, but we looked at a bunch of deals, and that means we ran numbers on them, we toured them, the whole 9 yards. And so, it's a lot, right? You definitely need to turn over rocks. I think that's real estate investing in general. And that's one of the nice things about being a passive investor is, by the time a sponsor brings you a deal, they should have looked at a whole lot of deals before they chose that one, right? And that's typically the case with a good sponsors. By the time they're showing it to you, boy, they've really turned away most overwhelming majority of the deals, right? And that's real estate investing in general, and that's what we do too. So if you are a sponsor, you need to figure out ways to streamline your process of looking at deals. One of them is criteria. So if you just start telling brokers, I want some deals, you can have way too much stuff, different markets, different sizes, different ages. So we just said, hey, we want we want between this year and this year, between this unit and this unit in this vicinity, these zip codes or this county or whatever. And then now anything that fits in that box, oh man, we're going to go see it. We're going to run numbers on it. We might fly a drone over it. I mean, we're going to go crazy looking at it to really understand it if it fits in our criteria. So you want to identify your criteria, and it may be different for different folks, kind of depending where you are in your career. And that will help streamline things a lot. And then you may want to utilize an underwriting service to outsource to. There are a bunch of them out there. One of them, sapphirepartners.com, you can go to, and they'll underwrite the thing for you. And look, if you're at work and you're learning this stuff, you don't want to spend 5 hours trying to underwrite it. You just send it off to somebody that does this all day. They send you their analysis, and that can cut down your workload a ton and help you get through a lot more deals for a relatively low cost. Great question there. We got another question here. Do you guys do any long-term holds? To Abel's point earlier, we underwrite 5 years. If we get out in 2 years, great. If we get to year 4 and another economic calamity happens and we can't exit, we needed to hold it 6 years, great. So long-term, if you're talking about like lifetime, give it to my kids type stuff, not right now. Usually you buy a deal, let's say you buy it, you put in $500,000 of improvements, and by year 5, it kind of needs another facelift. And so it's time to kind of sell it to the next guy, let them do that, is typically how these things work. Abel, you got a question there on your, on the groundbreaking project.
Yeah, so we've got a Reg D 506B deal that is closed, and we're just kind of working through it. That's the project in New Mexico. When I say closed, no new investors, and we're not accepting any funds or whatever, but it's the opportunity that we're trying to push forward right now. So it's our COVID deal. We started it before, and we're in the middle of it and try to push everything forward. But yeah,
that's gonna be a satisfying one, man. We got 2 COVID deals right now, and when they close,
yeah,
it's gonna be a miracle. Yes, we're going to Sizzler. I'll tell you that.
A COVID deal. You got it. You got it.
That's it. Well, this is good. We really appreciate the participation in the Q&A. Guys, this is awesome. We're going to have a recording out of this for everyone. We're about at time here, coming up on an hour. Is there any other kind of last Q&A you guys want to throw in? If not, we'll follow up and send you guys an email if you want to connect with Abel or I, or connect with the Apartment Educators team. We'll have an avenue for you guys to do that. Be sure to register for next month's event, May 7th. You can go to apartmenteducators.com now to do that and register, and that way it's on your calendar and you'll get a reminder. And I just, again, want to thank you guys for jumping on, and we really look forward to seeing you at the next online event, and we also can't wait till the world's in a place where we can shake hands and slap everybody on the back and maybe even buy you a drink. Really looking forward to those days. I think they are fast approaching. So thank you guys so much for coming out tonight. We really appreciate it.
Yeah. One more of the housekeeping things. You will when you register, we have a kind of a process. We'll ping you guys via email. So look through your junk mail. Add us as the recipient there, so it doesn't all go through. But you'll have all of our contact information via that email, and then that's a good way for us to kind of keep the communication on. We want to be compliant with our rules of email, and still, guys, get you guys on our newsletters and continue the education onward. So thank you very much.
Awesome.
Thanks, Evan. Thanks, Ruben. Thanks, apartment educators. Thanks, guys.
Thank all you guys. Take care.
Bye-bye.